you're living paycheck to paycheck, you're not alone. According to a survey by the American Payroll Association, 74% of employees in the U.S. live paycheck to paycheck. This means that if you started saving just $100 a month at age 25, you'd have around $144,000 by age 65. However, 78% of Americans never do this, and it costs them an average of $683,000 in lost wealth. The first step to breaking the paycheck cycle is to track your expenses. Write down every single transaction, no matter how small, in a notebook, or use an app like Mint or Personal Capital. This will help you identify areas where you can cut back and allocate that money towards savings. For example, if you spend $5 a day on coffee, that's around $1,825 a year. Create a budget that accounts for all your necessary expenses, such as rent, utilities, and groceries. Aim to allocate 50-30-20, 50% for necessary expenses, 30% for discretionary spending, and 20% for saving and debt repayment. For instance, if you earn $4,000 a month, you should spend $2,000 on necessary expenses, $1,200 on discretionary spending, and $800 on saving and debt repayment. Prioritize needs over wants. Be honest with yourself about what you need versus what you want. Do you need a new smartphone, or can you stick with your current one? Remember, every dollar you save is a dollar you can invest in your future. For example, if you save $1,000 and invest it in a high-yield savings account, you can earn around 2% interest, which is $20 a year. Build an emergency fund to cover 3-6 months of living expenses. This will help you avoid going into debt when unexpected expenses arise. For instance, if you lose your job, you can use your emergency fund to pay for essential expenses while you're looking for a new job. Aim to save $1,000 as a starting point and gradually increase it over time. Take advantage of tax-advantaged accounts such as 401(k) or IRA for retirement savings. These accounts offer tax benefits that can help your savings grow faster. For example, if you contribute $5,000 to a 401(k) and your employer matches 50%, you'll have $7,500 in your account. Over time, this can add up to a significant amount. Pay off high-interest debt as soon as possible. High-interest debt, such as credit card debt, can quickly add up and prevent you from achieving your financial goals. For instance, if you have a credit card balance of $2,000 with an interest rate of 20%, you'll pay around $400 in interest per year. Consider consolidating debt into a lower-interest loan or balance transfer credit card. Consider used or refurbished items instead of buying new. This can help you save money on everything from electronics to furniture. For example, a refurbished laptop can cost around $300 compared to a new one that costs $1,000. You can also buy second-hand items from thrift stores or online marketplaces. Use the 30-day rule when considering non-essential purchases. Wait 30 days before buying something to determine if it's something you really need. This can help you avoid impulse purchases and save money. For instance, if you see a new video game that you want, wait 30 days before buying it. You might find that you don't need it as much as you thought. Automate your savings by setting up automatic transfers from your checking account to your savings or investment accounts. This way, you'll ensure that you save a fixed amount regularly without having to think about it. For example, you can set up a monthly transfer of $500 from your checking account to your savings account. Take advantage of employer matching contributions to your 401(k) or other retirement accounts. This is essentially free money that can help your savings grow faster. For instance, if your employer matches 50% of your contributions up to 6% of your salary, and you contribute 6% of your $50,000 salary, your employer will contribute an additional $1,500 per year. Use cashback and rewards credit cards for your daily expenses, but make sure to pay off the balance in full each month. This can help you earn rewards and cashback on your purchases, which can be used to offset other expenses. For example, if you earn 2% cashback on all your purchases and spend $2,000 per month, you'll earn $40 in cashback per month. Avoid lifestyle inflation by not increasing your spending as your income rises. Instead, direct excess funds towards savings and debt repayment. For instance, if you get a 10% raise, don't increase your spending by 10%. Instead, put that extra money towards your savings or debt repayment. Consider a side hustle or freelance work to increase your income. This can provide a buffer against financial shocks and help you achieve your long-term goals. For example, if you earn an extra $1,000 per month from a side hustle, you can use that money to pay off debt or invest in a retirement account. Prioritize your financial goals, focusing on the most important ones first. Make a list of your short-term and long-term goals and allocate your resources accordingly. For instance, if your top priority is to pay off high-interest debt, allocate as much money as possible towards debt repayment. Use the debt snowball method to pay off debt. This involves paying off debts with the smallest balances first, while making minimum payments on larger debts. For example, if you have 3 credit cards with balances of $500, $1,000, and $2,000, pay off the $500 balance first, then the $1,000 balance, and finally the $2,000 balance. Consider consolidating debt into a lower-interest loan or balance transfer credit card. This can help you simplify your payments and save money on interest. For instance, if you have multiple credit cards with high interest rates, you can consolidate them into a single loan with a lower interest rate. Use the 52-week savings challenge to save money. This involves saving an amount equal to the number of the week. For example, in week 1, save $1, in week 2, save $2, and so on. By the end of the year, you'll have saved over $1,300. Take advantage of tax deductions and credits. This can help reduce your taxable income and lower your tax bill. For example, if you donate to charity, you can claim a tax deduction for the amount donated. Review and adjust your budget regularly to ensure you're on track to meet your financial goals. This can help you identify areas for improvement and make changes as needed. For instance, if you find that you're overspending in a particular category, you can adjust your budget to allocate less money to that category.